You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again for the Advisor's Option, the program here on the old network where we break down everything going on in the world of options that you, the busy financial advisor, probably missed because if you were doing your job this past month, you've been busy dealing with your clients, a lot of whipsaws, a lot of drama, more vol, less vol, all sorts of things going on in the market. So you probably had your phone ringing off the hook, probably been pretty busy. Luckily for you, we got you covered here with everything you need to know in the world of options and derivatives. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever-engaging, ever-insightful, at least we tend to think so, Options Insider Radio Network. Of course, for all of you on the advisor's side, maybe you have additional questions, you want to go deeper, longer, detailed answers, and we have time to squeeze into a show like this. Then, of course, our pro Q&A sessions are all for you, as well as, of course, options oddities and live access to this and everything else we do over there, theoptionsinsider.com/pro, the place to go to learn more about all of that good stuff going on over there. As we learn who's joining us on the old Advisor's Option program today, I am pleased to welcome back on once again our old friend, Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services, a.k.a. the Victor Frankenstein to Otto's Creature. Mr. Matt, welcome back to the show, sir.
I didn't know where you were going with that one, but that was interesting. Yeah, Mark, it's great to be here and on the pro sessions.
Yes, you have created life, sir. Congratulations. Hopefully it doesn't turn evil like the creature did. All right, a lot to unpack. let's keep on rolling and kick things off, listeners, as we are wont to do with the segment that was born from the madness of the pandemic and continues to rock these markets. Yes, it is time for the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement. You know, what the heck did happen in the options market since our last show? Spoiler alert, quite a bit happening in the broad markets as well. Of course, everyone was waiting with bated breath for Powell to speak again over there at Jackson Hole, and he did last week. And as a result, we have seen pretty much nothing but naked optimism ever since. Leading into the Jackson Hole announcement, we were seeing a lot of red on the broad market screens, vol creeping up, and a lot of whipsaws, a lot of intraday whipsaws, more than we have seen in quite some time. And that's kind of been the course for the better part of the last month. Intraday, you see a sell-off and then a rally, second half of the day, or maybe you see a rally early in the morning, then a sell-off. A lot of intraday whipsaws, which is interesting and a little bit aberrant out there. And of course, leading into Jackson Hole, we did see vol creeping up. Then apparently the market really liked what Powell had to say. Either that or they're just whistling aggressively past the graveyard. Either way, we've been mostly rallying since that session. When Jackson Hole happened, we were hanging out around the 4,300, 43 half level, I believe. Threatening 4,500 again, the S&P right now, 44.90 or so, kicking off the show. S&P up another 55 handles, or about 1.25% today. So they are liking themselves this market again, and also a bit of a rarity. Post Jackson Hole, we haven't seen as many whipsaws. It seems like the market is pretty much just picking a direction and going with it. And today, that direction once again is in the green. And of course, all this green post Jackson Hole means all that juice, all that froth that built into the market. We did see VIX since our last show climb all the way intraday to pretty close to an 18. Yeah, we topped out right around 1790, 1789. And now we have come off that quite a bit to about 1460 as we're kicking the show off now. So a lot to unpack there, Mr. Matt. A lot going on since our last show. What caught your eye out there, sir?
Yeah, it did look a little hairy there for a while. I was liking my 3,500 before 5,000 call for 5,500.
You still got a chance. I told you it's going to go 49.99, right? And then just turn to the dark side.
And then turn, yeah. A lot of my indicators went from bullish to a little bit bearish, actually. So, we started to get a little bearish out there for a while, but now it's turned a bit. But I still like even though it's climbing, there's some higher vol numbers, but vol's coming down, so that's good. Contango is still there, but it's not as prevalent as it was before. So that's the front month versus the back month. Those are things that we look at. And then, forward vol relationships, they got down, but they're coming back up. So they, right now it looks like a blip, but our indicators are worried right now, even though they're getting somewhat positive with the falling IVs. They're starting to get up there. I think people are starting to get concerned, and they're showing their concern in the options that they're buying or selling, and the prices are going in such a manner that we capture those and we try to see what the relationships are. And, it's looking a little bit more worried than usual, recovering from that kind of quick down step that it took. But, yeah, as you said, Fed to the rescue, Mark.
Yeah, a lot of people were hoping maybe coming into earnings season, we'll get into all the earnings fun in a little bit, but coming into earnings season, maybe we'd be a little bit post-Fed for a little bit. But you know what? It seems like the Fed is never really too far in the rearview mirror these days, Mr. Matt. You can't get away from it. Even in between Fed announcements, we have things like Jackson Hole, or, of course, your errant Fed governor here and there running off at the mouth on CNN and just sending markets into a tailspin or into a rally. So it does seem like the Fed, unfortunately, is still inescapable out there in the markets, and continues to drive us, in this case, driving us north out there, listeners. What about you? Are you buying what this rally is selling? Are you like Matt, maybe a little bit skittish out there right now? Are you leaning 3,500 before 5,000? Matt's still beating that drum. Yeah, we got a chance. Everything has a chance out there at the end of the day. I know a lot of you, when we did it on the last show, kind of faded it, but I would imagine if we did the poll right now, Matt, given the near-term upside bias, the numbers would be similar, if not more heavily skewed towards 5,000. But, you never know. Time will tell out there which of those will prove salient. As we keep on rolling, listeners, a lot going on in the world of options since our last show. So let's get to it. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody. Welcome to The Buzz, a portion of the show. We break down some of the big developments in the world of options since our last show. And again, ever since the onset of the pandemic, one of the biggest developments, the most closely watched thing in the world of options really has been the volume. Can the volume keep pace with this mad level we seem to be setting year after year? And so far, the answer has been a resounding yes, year after year, in fact, exceeding it year after year. Back in 2020, we hit volume levels everyone thought that's insane, and then we exceeded it in 2021, and then we topped it again in 2022, and here we are a good chunk of the way through 2023, and it seems like we are on pace to hit it yet again. In fact, we are recording this right at the tail end of August, listeners, so in a couple of days we'll know for sure about August. August, usually a pretty quiet period, the dog days of summer, after all. Not exactly known for being the most robust liquid periods in the market. Usually pretty thin, but we have seen impressive volumes. I was talking on some of our shows recently. Products like VIX and even the SPX, which tend to languish this time of year, usually from a volume perspective, are looking very robust. SPX threatening 3 million contracts a day right now in the dog days of August. VIX threatening 750,000, so 750,000 contracts a day in the dog days of August, when you'd be forgiven for expecting maybe 400, 450, something like that. So, yeah, these are pretty robust times out there from a volume perspective. And July, of course, we have the numbers now for July. July also not known to be the most seasonally active period in the market. After all, the old adage, right? Sell in May and go away. It tends to apply to options volume as well. And yet July saying, you know what, we're throwing all old adages, old conventional wisdom out the window these days, because July coming in pretty hot, not quite threatening the 1 billion contract level, but pretty hot for a July. 877.9 million contracts changing hands in July, listeners. That's up 18.3%. From July of 2022. We all know 2022 was no slouch from a volume perspective, so that's a pretty impressive July. I mean, when we're threatening 900 million contracts in the middle of summer, that just shows you the kind of pace we are on from an options volume perspective. A year-to-date ADV, so the average daily volume of the entire options business these days, listeners, was 44.6 million contracts through the end of July. That in and of itself is up about 10% from this time last year. So, of course, if that holds pace through the rest of the year, we're talking about a probably 10% increase from what we put up this time last year. Some other highlights out there: ETF options up 13.6% year over year. Let's go out here. This is the one everyone's focusing on as well, because the other question everyone has, listeners, is, of course, the zero DTE stuff. What's going on with that? How much of an impact is that having? And right now, that is most clearly seen through the lens of index options like SPX. And index options this year, listeners, up 41.2% from this time a year ago. And this time a year ago, we were just starting to come into the early bloom, the first blush of this zero-day revolution that has kind of reshaped the options markets. They had listed back in, I believe, late April, and so they were just starting to come into their own. We've had a few cycles at this point of expiration for them, and they were starting to really come into their own. And now here we are a year later, and 41.2% increase. Again, SPX threatening 3 million contracts a day in the dog days of August. A good chunk of that coming from this zero-day palooza now. So a lot to unpack here, Mr. Matt. Yet another surprising number for the month of July. I have to assume when we see the numbers for August, it's probably going to be something similar. Goodbye to the quiet, lazy days of summer, Mr. Matt. What happened to sell a May and go away, sir? It is gone.
Yeah, it's been an interesting market, Mark. And yeah, it's not just the sell in May and go away market. We've had obviously a big earnings in July, and a fair amount going on. I think still the biggest story is the zero DTE phenomenon. We've talked about it at length. I came out early saying that it wasn't going to lead to Volmageddon like people were saying, Marco on CNBC and a lot of other people. And I actually was saying it's going to deaden the market a bit, deaden the skew a bit. And then, that's what we're seeing. We're seeing, and then I think my thesis is that it's great for market makers to have all that volume in the 0 and 1 day, because they could, they aren't beholden to the natural positions that they get in. I remember on the floor, we'd always hate, market makers want to be in and out of their positions. They don't want to be holding these positions, and then that's when the skew really gets off. So, for example, banks were buying puts from the market makers, so the market makers put an inordinately high skew in the market. Well, that is basically gone. I'm fortunate that we, our data, accurate proprietary calculations go back to 2007, so I could see these trends, and our clients can see these trends. But what I'm saying, we have the slope number, which is basically the skew, and it basically is how high are the puts compared to the call, the low strikes puts versus the high strike calls. That was really high for a long, long time. But I think, as zero DTE was introduced, the skew got lower. So the puts became less dear, meaning the market makers could take some of the air out, or some of the higher implied volatility out of the puts with the zero DTE, because they knew they were going to be able to cover their positions, which is naturally a put seller call buyers for a market maker. That's not so much anymore with the zero DTE. So it's flattened the skew, I think, deadened the market. And when I say dead in the market, the historical volatility versus implied volatility. So basically how you value implied is you look at historical mostly, and that relationship has been tightening. So when you get high implied volatilities versus historical volatilities, when you get that historical volatility moving outside of a range that is predicted. So implied volatilities tries to predict historical volatility. That range is tightening. So, I think a lot of the uncertainty and is coming out of the market, and it's kind of deadening the market. And I think a lot of that has to do with zero DTE. So I think that's the biggest story, Mark. And then, you say 40% increase in volume. That's not surprising. It's, there's quite a lot going on. And even my personal trading, I use the short-term zero DTE SPX to, I have an overall position that I have on, and I use the zero DTE to, do certain things that I think are short-term trends against my longer-term positions. For example, my longer-term position is, kind of a put calendar. So I'm, if without the zero DTE part of my positions, I would want the market to go down to that calendar. It's out of the money long-term put calendar. And then what I do until our volatility numbers would kind of signal a real downturn in the market. I have some short put spreads. I have some short-term call calendars on. So I have some longs against the natural shorts that I have. So I think the market makers are doing the same thing with zero DTE. And again, I think it's deadening market, flattening the skew, keeping down historical volatility versus implied. And that's been, quite an interesting year or what is it? Time of the zero DTEs entering our option market and seeing what it's doing to a lot of the numbers that we track, Mark.
Interesting you say that, because a lot of the speculation in the early days, of course, was that zero DTE was exacerbating vol, right? And that was the big concern. And then, of course, last year we were talking about is VIX broken because it wasn't moving much, and was zero DTE part of that or not? And then, of course, you're right. As we've seen some data now, it's strangely, I would call it oddly symmetrical, the flows we're seeing in, let's say, 0-day SPX. You know, most products, you're going to see a bias one way or the other. You know, you mentioned a lot of customers are out there buying puts and selling calls, and a lot of the major equities and indexes out there. You don't see that in the volume in 0-day. It is weirdly symmetrical. Pretty much every day, day in, day out, the same number of calls and the same number of puts trading, which is surprising. You don't really see that in a lot of products, listeners. And also, you're right, might have a little bit of an interesting muting effect. So there's a lot to unpack there in the world of all things 0-day. I think we really are only in the first innings of this game, maybe even in the warm-up cycle. We haven't seen the impact of, let's say, 0-day Apple, 0-day Tesla, all the things you folks trade outside. Look what it did for SPX. And a lot of you prior to that didn't really trade SPX. So imagine what it could do for a lot of the products you folks are actually trading day in, day out. So that's pretty fascinating. Speaking of that, Matt, our question of the week right now, I wanted to get your thoughts on this. It dovetails with this conversation about 0-day very nicely, because we're asking right now, quite simply, which product has had the largest overall impact on the options market? So we're going 10,000 foot, looking back, looking down, historical perspective, whatever you want to call it. We gave you three choices and the infamous other. So we said VIX, we said the weeklies, or we said these new daily options / 0 DTE, whatever you want to call them, or other, and people can reply with all sorts of crazy others if they are so inclined. Mr. Matt, which of those do you pick? Or maybe you have your own write-in you want to suggest, sir. Have at it.
Yeah, I think it's the 0 DTE, just for the reasons that I said before, at least, recently. I mean, obviously VIX has done a lot, especially with its informational content, but I think the 0 DTEs now are like the effect it's having. It's a 800-pound gorilla sitting in the market right now, so I think it's going to be that. But I think a lot of people will say the VIX, but that's what I think it is.
Yeah, it's kind of hard to unseat the VIX, right? Because it has decades of history. It created effectively a new product category for people to trade, which is, of course, volatility. Look at all the ETPs that have sprung off of it since then, your VXXs and your former XIVs and your TVIXs and SVIXs, and all that stuff wouldn't exist, obviously, without the VIX. So the impact there is monumental. On the flip side, 0-day obviously only has about a year really behind it. Obviously, you could trade on expiration going back to time immemorial. I get that. But this 0 DTE phenomenon only has a year behind it. Right now, of course, it's having a lot of impact. I think the jury's still out long term. It's hard to compare, I think, the two. So for me, the answer would be VIX. And again, I hate to give my answers because then I'm going to color the results. So hopefully we'll post this a little bit later in the week. So we won't color people too much, Matt. But interesting. I think there's arguments for all of them. The weeklies were the big thing, right? Until 0-day came along and kind of stole a lot of their thunder. So there's a lot to unpack there. I'm curious what some of the write-ins are, because you could write in a lot of things maybe were interesting to you. You could go the binaries. You've had quite a few flirtations with those in the options business over the years. There's a lot of other products out there. Maybe you like a different flavor of vol. Maybe you like something else. Maybe you're a really big fan of the skew index. I don't know. I don't judge. Write in what you like over there. At Options is the place to go. Right now, Matt, interesting. Looks like people are listening to you, Matt. They're going 0 DTE, 42.1%. Maybe a little bit of recency bias there, but it's hard to blame them at the end of the day. Weekly's number 2, Matt, 31.6%. That's kind of interesting. VIX bringing up the rear, 26.3%. Not a single vote for other. Everyone's going for our established categories right now. Are you surprised Weekly's so strong, Matt?
I think that's a little bit of an offshoot to the 0 DTE. So, if you add both of those together, I think it's almost a 0 DTE phenomenon. But, weeklies is more single stock, I'd say. Obviously the dailies are in the SPX and those types. But, I'm not that surprised, I guess, with weeklies. I thought VIX would be higher, but...
I thought VIX was taking it in the early blush, but apparently not. Yeah, if you add the weeklies and dailies, so if you just take short duration and lump it together, that's nearly 75% of our votes right now. So folks loving themselves, a little bit of a short-term bite at the apple, Mr. Matt. So Intriguing stuff out there. That's, of course, our question of the week that just went live yesterday. Listeners, by the time you hear this show on the network later this week, I'll have a few more days behind it. It's a reason why you should be following us at Options throughout the week. You can participate in this, obviously get access to all the shows we're putting out there, a lot of other great content. Everyone loves the most actives we put out there every day. We do those multiple times a day. Folks also like when we put out a lot of Matt's earnings data. So let's get to that now, a little bit of the old earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, everybody, welcome to the Earnings Volatility Report, the portion of the show, again, born of the pandemic, because Matt's been crunching this data for a while for us over there at the Options Insider, and we noticed an intriguing, perhaps disturbing trend in the early onset of the pandemic, which was earnings volatility really didn't matter anymore. Nobody gave a crap. It just no matter what a company said, they could throw out their guidance for the next decade, and it didn't really matter what was going on. Vol came in regardless across the board. So it was a fascinating, somewhat unique time, and it really made the analysis of this vol even more interesting as a result. So we've really kind of doubled down on this, hence the inception of this segment as well, which is, of course, the Earnings Volatility Report. You know, for a lot of your clients out there, they are interested in this. And this is, of course, a driver of a lot of market activity, a lot of volatility during earnings season. So it's something you ignore at your peril, which is a long way around to saying, Mr. Matt, we were coming into this cycle and we were thinking, this was it. This was going to be the one where we would see maybe the lingering impact of the R word looming on the horizon. You might see some of the potential recessionary impact. We're going to see some dire numbers out of these names. So far, last I checked it coming into today's show, we were hanging out at exactly break even from an earnings vol perspective, exactly 100%, listeners. So what that means is if you're looking at our season report, we price everything in based on how much they're pricing in from a straddle perspective. Right now, everything is averaging out to move exactly as much as their straddle. So that's pretty interesting in and of itself. So Mr. Matt, what are your thoughts here on this current cycle and perhaps any surprises or things that made you stroke your chin and say, as we're watching these numbers, sir?
Well, the earnings season is heavily affected by just the volatility of the overall market. So we had some, we rallied into the end of July. And so, in those cases, they keep the vol kind of low and, you'll get a lot of movement. So we saw the first couple of weeks with a lot of movement versus what was implied in the market. So the option straddle owners did well. But what happened right after that into week 4, which is usually a really good week to own vol, the implied earnings effect, which is usually about 5.5, went up to 7.5. And then that just crushed the returns. And so, and then they, and then as you get later on in the earnings season, then you get the bigger movers, but by that time, we had a really bad week 4. So, basically, the way I would look at this earnings season is, the weeks 2 and 3, which are the biggest weeks, were big winners for straddle owners. And I think that has a lot to do with, at that time, there wasn't much volatility in the market, and so a lot of people were looking at the earnings. I think the earnings are getting, they're having poorer outlooks, but everyone thought it was going to be even worse. So it's kind of an interesting way that it's going in earnings. When we're sitting at a 23 PE, which is astronomically high in the market, you have to hit all your numbers, and they're just seeing that these companies, save. A couple aren't really hitting their numbers and having the projections out into the future that they need to sustain such a high PE. So what we saw in the earnings season is, about week 4, week 5, the market really puked out, raised volatility, and then the straddle owners going into those high volatility earnings didn't really make enough to pay for their straddle. So that's what we saw in the overall earnings. As far as going forward, there aren't obviously we're trailing off right now. just a few, smaller stocks. I mean, we're still having, 15, 20 stocks reporting, but it's nothing like the main weeks. Now we're tailing off, and we're just kind of looking at things today. Best Buy came out. They're up 5% today. Volume's pretty high. Obviously volatility came way down. A couple of the other stocks came out, pretty typical behavior. Vol gets crushed after earnings. PDD today as high volume. They're up 16.75%, so that was a bit of a surprise. So, overall, the earnings season, Mark, I think, especially going into it, our predictions were we're going to see a lot more movement versus expected, and that's what we saw. But then, as the market puked out a bit and the IV went up, the returns weren't as good. So that's what the earnings season was looking like, Mark.
Yeah, Best Buy. How long have they been sounding the death knell of that name, right? And yet they continue to persist. Up nearly 5% again today. So apparently people are buying their products again over there. So you can make money in brick and mortar retail, apparently, in technology these days. Interesting as well. Yeah, I did not have on my bingo card, Mr. Matt, exactly 100% this far into the cycle. We don't normally see that. So that is pretty interesting right now. Of course, listeners, if you want to see all this data for yourselves, you know where to go, theoptionsinsider.com. Click on that Options News and Articles tab. That'll begin your journey to the dark side. Fair warning, you're going to go down a rabbit hole with this stuff, but you're going to like it. We also tweet out the links to it so you could see it there as well if you're following us at Options. Intriguing stuff. So far, it seems like the dark side week was week 4 at about a 78%. That was kind of the most underperformance that we saw. Everything else was at or above pretty much 100%, with the exception of last week. It's week 6 at 93%. So intriguing stuff out there, listeners. A lot to unpack. We'll keep an eye on this. I don't think anyone had a par in their bingo card, but we shall see. We're not done yet. We still have to tally up some of the numbers out there. That number will probably change. If I had to guess, it'll probably drop a little bit below 100, but you never know. You never know. Time will tell. So it makes crunching these numbers so fun. And if you or your clients are even remotely interested in trading around this time of year, very informative. And the fact that we give it to you folks for free, because we like you folks, we must be really nice, because otherwise you have to go pay a boatload to a research house to do this kind of data for you, and probably wouldn't be as good. So check it out, theoptionsinsider.com. As we keep on rolling, listeners, it's time for you to do a little learning about these old options things for your clients, because it's time for a little bit of the old Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, the portion of the show where we break down some options concept or strategy or tip or technique and explain how you can utilize it in your clients' portfolios. And today, Matt, this was inspired by a conversation. We had some feedback on our Options Bootcamp show, which is our kind of mainstream educational show. You've been on that show in the past, Matt. And there was some inquiry, some interest in risk reversals, in particular bullish risk reversals. And it was a topic we hadn't touched on in a while there, so we kind of went deep on it recently there. And as we were doing that, I thought, it might be an interesting conversation to continue with this audience, for the advisors audience. A lot of them who are obviously managing a lot of long equity accounts. This is a position that could be useful for them in a couple of different ways, both on the bullish front, and of course we've talked about the flip side of that with stock, the collar, many times on this show in the past. I've called that the holy grail position for a lot of advisors out there. But before we get into that, Mr. Matt, give me your first impressions, your thoughts, your word association. When I say to you risk reversal or perhaps bullish risk reversal, what do you think of, sir?
Yeah, sometimes it could work real well. You really have to know, what that slope is, because you're getting a lot of skew in the position that you're putting on. So, right now the skew is pretty shallow. So, it's not that great of a time right now. Meaning, you're selling a put, but the relative relationship between the puts and the calls is really low compared to what it usually is. So you're selling into a low skew environment. So you're selling it and it's already low. So you want to sell things usually when they get high. So it's, I think it's a really good thing to do when the skew's really steep in your favor, because you can make money kind of both ways. You could make it on the skew changing and the delta's going in your favor. And you know me, I don't like to be naked short puts, and so this is really the way that I like to do it. What I like to do more is, I don't want to. So essentially, you're selling a put below and buying a call above to participate. And generally, the call doesn't give you enough, is what I've found. And the puts that you're selling, just create a lot of risk. So, what again, I don't want to poo-poo our big topic here, because I think a lot of people do it, but you could do other things, meaning you could, instead of just being short a put, you could be short a put spread or put diagonal. Those are ways that I like to do it. And then just as an aside, Mark, this kind of reminds me of the wheel strategy. Wheel strategy is when you sell a put, and if you get exercise, you keep the stock and sell calls against it. We're looking at I haven't seen that back tested on a platform before, so that's going to be our newest thing coming out, is that wheel strategy. It's difficult. Our programmers did a great job on it. So it's much different than a usual strategy. So, but I just don't like the risk that you have in that short put. I don't think it's worth it for most investors. And so the next thing we're going to do is some type of a put selling a put spread instead of selling a naked put, or my favorite is selling, or is doing a put calendar for a credit. So you can sell a near term put, but buy a far term put with it, and you could even do that for a credit. So long story, that's my initial feelings, Mark, about the risk reversal.
A lot to unpack there. I like what you mentioned. First off, you mentioned the skew nature of this, and you're right. This is a skew trade. In fact, that's how I first encountered this term. Everyone's always asking us about, the etymology of these various options terms. And risk reversal, to me, was always introduced back as a way to kind of reverse your skew risk back on the floor. Back, of course, in your market-making listeners, you have a lot of residual positions. Maybe, let's say, you're long a lot of out-of-the-money options into the downside, so you're long a lot of traditional puts and short calls to the upside. Maybe you want to flip that. You want to reverse that skew risk, so you're going to sell put and buy call. That's where that name at least came along for me. I mean, the origins of these things are kind of lost in the sands and mists of time. A lot of them don't make any sense, like iron condor and iron butterfly. Don't even look for reasoning there. That's how I really first encountered these, as a way to kind of change up your skew risk, hence the name risk reversals. This is a skew trade. And you mentioned, you're right, Matt, there's a lot of different ways we could carve up this apple here. We're going to talk the basic way first. Then there's a lot of additives, a lot of tweaks we could do to maybe make it more appealing for a lot of our listeners and for a lot of your clients. But let's start with the basic thing first. What the hell are we talking about? Matt kind of just laid down the broad strokes of it. We're going to start with the bullish risk reversal. Let's go to your favorite name. We've all made and lost fortunes on this one, listeners. Of course, XYZ. Let's say it's trading at 100. You have a client who's intrigued about it. Maybe you're intrigued by it, I should say, on behalf of your clients. Either way, you like it. You think the underlying is going to rally in the near term, over the next month. So you're pretty near-term bullish on this thing. Obviously, you can go out and just buy the stock. But let's say for some reason you can't. You don't have the full capital. Maybe your client doesn't want to commit to buying the stock and that full outlay. For whatever reason, you can't or won't go out and just buy the underlying. So what can you do in the options? A lot of different things. You can buy options, trade up at the monies and things, but those are going to be kind of expensive. You can buy verticals. We talked about all those before in the past. Another way you could go about getting a lower cost swing at that upside apple is something called the bullish risk reversal. So the first leg of this trade, you're going to look out and you decide, you know what, you don't mind buying this stock if it dips a little bit. Let's say in our example, if it drops below 95 over the course of the next month. So you go out and you sell that 95 strike put. In our example, you can get that for $1. Keep things nice and even and straightforward. So what have you done now? Of course, we've talked about short puts many times. You know the deal. You sell that 95 strike put. You collect $1. So you've effectively locked in buying the stock to the downside at $94, which is that $1 cushion taken away from that strike there. So short put, we get it. You know the margin requirements for doing that. It's no free lunch trade. You're going to tie up some capital, which is one of the reasons I'm sure Matt is a little bit skittish on that. So that's nice. You collect the buck. You got that part of it. But now we're going to add another leg to this, and that's what makes this the bullish risk reversal. You're going to turn around and say, you know what? Selling the put is fine. That gets me in if the stock drops. But what if the stock runs? I think this thing's going to run over the next month. How do I participate in that? That's where the next leg comes in. You say, I'm going to turn around and buy an out-of-the-money call. In our example, equidistant $5 out of the money. You're going to buy the 105 strike 1 month call as well. You know, we were just talking about skew. You know, in most equities, the puts are going to trade at a higher level of implied volatility than the calls. So in our example, this equidistant call, $5 out of the money, it's going to be trading for roughly half the price, 50 cents. Keep things nice and easy. So what have you done now? You sold 95 strike put for $1. You've bought a 105 strike call for 50 cents. So right off the bat, you cut the premium that you're harvesting in half. So there is a cost to this, but you're still collecting 50 cents at the end of the day. Also remember, you're selling a put, so you're selling a negative delta there. So that's a positive delta trade. And then you're buying an out-of-the-money call, which is also a positive delta. So you add those two together, you get a pretty meaty delta on these trades, which is why they are a decent approximation for the underlying without having to buy the underlying itself. You know, depending on how you set it up, you're probably going to get at least a 50 delta on these, if not more, 60, maybe even 70, if you get kind of aggressive with some of the delta. So you can see now why you're collecting a credit, or maybe you're just getting even money, low-cost way to get a pretty high bullish delta trade on, which is attractive to a lot of people. So in our example, a couple of different scenarios here. The stock expires above 105, in which case you participate on all that rally above the 105 strike, plus you have that 50-cent credit in your back pocket to boot. So a nice little trade there for you. Let's say in our example, closes at 107. What happens? That 105 strike call goes out at $2, and then also you have that net 50-cent credit you collected from the trade. So $2.50. That's what you turned it into. Not a bad trade at the end of the day. If it expires anywhere between $95 and 105, which is, of course, the two strikes that you traded, then effectively you're just keeping your credit. Both options expire worthless. You still pocket 50 cents. Not the end of the world. Scenario 3, stock drops below 95 at expiration. Then you're going to buy the stock. Now, this time you've moved up your break-even a little bit because you reduced your credit. So now your break-even price is $94.50. So just bear that in mind. You're on the hook for that, which is one of the things that made Matt a little skittish on this. So you can see kind of some of the pros and cons of this right away. Again, don't get hung up on the debits and credits with this. We kind of do this as an example just to show you how it works, but that should not be your primary concern with this. It really should be a way for you to get a fairly low capital outlay swing at the upside bat in these names. As Matt mentioned, there is downside risk to this. You could add different legs to this in a lot of different ways. You could, for example, sell a put spread instead of a put, and now you've reduced your credit even further, but you've also minimized your risk to the downside. If you don't really want to buy the stock, if you really want to do more of the upside play, then that's one way you could do it. Matt also added that put calendar in there instead, so you can get really funky with that stuff. If you wanted to the upside, you could buy a call spread instead of a call. That would increase your credit, I should say, that you're collecting. There's a lot of ways you could play with this, but that is your basic bullish risk reversal. Again, a good idea, a good way to maybe get a not entirely full cost swing at the bat that would be just buying the stock outright, listeners. That's, of course, a highly capital intensive trade. This is going to have some margin. Obviously, look into, we've talked about in the past, the margin, how brokers calculate it for short puts, because it's not a free lunch trade. There will be capital set aside for this. So it's up to you and your clients whether that's worth it. But this is one way from an options perspective. Then if it doesn't work, this is near dated trade. You could set it and forget it, do it again over and over again. So that's what makes it nice, as opposed to just putting all that capital into one trade and then watching the market move up or down and having to live with the results. So intriguing stuff out there. You can obviously flip this around a little bit too. You can go the other way. I think the stock's going to drop. So instead of selling that put and buying that call, you're going to flip it around. You're going to go the bearish risk reversal. You're going to buy the 1 month put for $1, sell that 1 month call for 50 cents. So everything is pretty much flipped now. Now you've bought a put, so you're expecting the stock to drop. If it rallies now, you talk about that margin, you're selling a naked call. So we've all seen what happened in 2021 and 2022, and even this year. Stocks can run to the upside pretty aggressively. So your broker is going to margin the heck out of you for that naked short call, which is why we said many times, don't do a lot of naked short options, especially to the upside in a lot of these names, because your risk is infinite. They're going to tie up a lot of margin for that, which is probably going to make this trade not tenable for most of you out there. But that's a different way you could go if you wanted that kind of lower cost bite to the downside. Of course, you have high margin costs for that, which is why we don't really recommend the bearish risk reversal on its own. We tend to prefer what we've talked about many times on the show, which is the collar, which is doing that with a stock leg. So in this case, you own the stock at 100. You buy the 95 strike put for $1. That's expensive. You sell the 105 strike call against it for 50 cents. So now you reduced your outlay for that put to only 50 cents. You can add a short put against that as a put spread for another kicker, reduce your outlay even further. Now you have protection. You have a little bit of an income stream on an underlying that you already own, and your margin isn't going to be through the roof because you own the stock. So that will protect you against that call. If the stock explodes to the upside, your stock will just get called away. So there is no crazy margin requirement. So I definitely prefer this as a collar versus the straight up options version, the bearish risk reversal. Mr. Matt, what are your thoughts on flipping the script and doing it the other way, the bearish risk reversal, and doing it as a collar versus not a collar, sir?
While I was sitting here, I threw some back tests at our back test engine, and so I think this is pretty interesting. So then we could talk about the reverse reversal. So if you just did a SPY risk reversal in a typical 30 delta, 30 days out, buying calls, selling puts, you're going to get the return since 2007 average annual returns 4.7%, whereas the stock is 10% on average. However, the Sharpe ratio is 0.5, whereas the stock's is 0.7. So it's got a slightly worse risk reward, which is the Sharpe ratio. And if you were to, for example, just do the stock with a long put, that increases your Sharpe ratio slightly over just typical long stock. And then if you do a long put calendar, you increase your Sharpe ratio, small, but you keep increasing it. And the Sortino, which is the downside volatility, downside versus returns, is increased. So, even on that perspective, the risk reversal is, I would say not the best strategy. Now, it does have a better drawdown, because your drawdown is not going to be as high, meaning the long stock is going to start losing money along before the short put. But still, I think what we're seeing from the numbers and from just logically looking at the position is it's a fair amount of risk to have for not as much return as I think you want, and that's what we're seeing in the Sharpe ratios, which is the average annual return divided by the volatility of the spread. So we're seeing that, and so I'm just not the biggest fan of the risk reversal just hanging out there. Yeah, collar, better way to go, less risky way to and plus you could still retain your stock if you need to do that. As far as reversing the whole thing, I think it's probably even more risk versus reward on looking the other way. So again, it's not a strategy that I would usually do. Maybe for a lower price stock that I could get into later, but for the market, getting in the risk reversal does not meet my risk appetite, Mark.
Not your favorite out there. Yeah, it's interesting. It's a very kind of vanilla strategy on its own, as Matt just kind of outlined. There's a lot of different ways that you could play with this and tweak it and really customize it till your heart's content. We don't have time to spend the rest of the show and many shows really on all the different nuances and the ways you could tweak it. But it is intriguing to look at these different strategies. At the very least, we're not advocating any approach for you out here listeners. It's really more just to arm you with information. So when you hear these terms, or if your client brings them to you, you see something about them in the market, you're familiar with what they're talking about, and you have some sort of conversational knowledge, working knowledge of this stuff going out there. But I do like your suggestion, Mr. Matt, about the wheel. It's a great strategy. A lot of people love it. A lot of people in the asset management space love it. It might be an interesting time to revisit it on the show, maybe say in an upcoming episode. What do you think, sir?
Yeah, that'd be great. We'll have a big back test with it, so it's going to be really cool to see it. And like I said, we haven't put the resources to doing it because it has a lot more moving parts, what ifs and such. But now that we're doing it, it's going to be interesting to run, and then also we're going to try to run some different ways of looking at the wheel strategy. And that's instead of doing a short put, do a calendar, a long put calendar, but for a credit. So it's more of a diagonal for a credit. So is more kind of my that's my flavor of the wheel strategy, Mark.
Maybe we'll bring our buddy Mr. Tusaw from St. Charles Wealth Management on, because I know he's a big fan of the wheel. They use it a lot there. They call it the triple income strategy there. But I know they're big fans of the wheel. A lot of asset managers like themselves the wheel. So it might be an interesting time to revisit that. So we maybe prepare for that on an upcoming episode, listeners. But now it's time for us to tackle some of your questions. It is time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Let's get to it now on the office hours here. Let's start this off. I like this handle, Bestiary. That's old school, medieval. You don't see that around very often. I like it. Bestiary wants to know, I normally sell 5% out of the money calls in a variety of single names to generate an additional income stream for my clients. Now it seems like I need to reduce my call writing down to at the money, or maybe 1% out of the money, to generate a similar or lower income stream. When I check my potential P&L graphs, the loss of most of my clients' upside gives me tremendous pause when considering these positions. Is it time to reconsider writing covered calls, at least until volatility increases? Matt, you were kind of just talking about this and some of the tweaks you would make, some of the strategies we were discussing to preserve some of that upside. I know for you, running all your back tests, you've had some questions about the covered call of late. What would you say for our listener, Bestiary? Sounds like he's managing some money. Used to love himself a good covered call, and these days he's a little bit more reticent, sir.
Yeah, I'm not a huge fan of long stock covered calls. It's really a short put. But what should be helping Bestiary out? Yeah, the volatility is a little low, but you've had some chances with the vol spiking as you brought before it got near 18 in the VIX. But what should be helping them, and I think what you want to look at is the skew, and the skew, is favorable to covered call sellers now, because the puts versus the calls are going down, so the calls are higher vol, so there are better sale out there. So I don't know. I mean, this is the time when I kind of be thinking more about covered calls, just because of the relative valuations there. Of course, I always like to have some hedge out there. So, again, that's almost talking to your caller instead of just a covered call. But you could do a caller where you still get some credit out of it. I like Tusaw's triple income strategy. That's a pretty well-marketed way to say the wheel strategy. But the wheel strategy on its own, I think, is a little bit too risky too. So it has to do with your clients' risk tolerances and what they have with in other parts of their portfolio. But for me, I like to have a little bit more protection than a covered call strategy, Mark.
You'll have to ask him next time he comes on what that third income leg is. Obviously, you're selling the put, there's income. You're selling the call, there's income. I'm assuming they mean appreciation in the stock as well. that third leg is a bit of a stretch, but we'll get it out of him next time he joins us on the show and we dive deep into the wheel. But Mr. Matt, that music means we come to the end. I told you an hour was going to fly by when we're having fun. Did you have a good time on the show today, sir?
Always a good time, Mark. Yeah, I mean, I always learn something, even just talking to you, but just diving deep in your insightful questions, and so hopefully your customers like it as well.
They seem to be enjoying it, Mr. Matt. And before we go, if folks want to enjoy more of your stuff, maybe they want to come one-on-one, have an encounter with your creature known as Otto, where should they go? What should they do, sir?
Yeah, I mean, it's really getting good on our dashboard product. If you like a UI, or our data is still really popular. Just some of the latest things that we have. Obviously, we have a stock scanner, option scanner, but we have this new kind of overview that shows how the volatility is versus all the components of the ETF, the best related ETF for certain stocks, and we track that historically. So that's a really good way to value the volatility. And we have scanners, but the back tester, and then when we get the wheel back tester, and that's going to be super exciting. So come to ORATS.com, be part of the community there, and just see all the great work our devs are doing and bringing to you. There's going to be some really solid stuff. We're working with Interactive Brokers now to bring that brokerage platform in. It's a little ways off. We have Thinkorswim in right now. We have TradeStation and we have Tradier. So you could trade directly from our platform into those fine brokerages, and we keep growing that. So it's really integrated. If you find a good backtest, you could send it to the option scanner. You can create alerts when they get out, what percent profit, and it'll email you or text you. So it's been great. I love trading through it. So I hope the ORATS, Matt at ORATS.com if you have any questions. And yeah, thanks, Mark.
Check it out, Matt at ORATS.com. You haven't lived until you've hung out one-on-one with Mr. Otto and all the rest of the cool tools they have lurking over there in the land of ORATS. Give them a follow on Twitter while you're at it as well, at OptionRats, all one word. A lot of great data and fun, snarky comments coming out on that Twitter handle in between episodes of this program. And, of course, check out our friends over there at the Options Clearing Corp as well, optionseducation.org, the place to go to kick the tires and light the fires over there. A lot of great data, a lot of great studies, including great podcasts, educational podcasts on this very network. So if you like the educational side, you want to check out some more educational content coming from our friends over there at OCC, you can just check out the Wide World of Options in very many ways, a sister program to this, where they break down some educational concepts in a lot more detail over there. You can find it if you subscribe to our full network. It's coming into your feed already. If not, what are you doing? You should be subscribed to that. And then you can also go subscribe to it directly. Wide World of Options is the place to go to check that one out on wherever you get your favorite podcasts. That's going to do it for us right now on the Advisor's Option. For all you pro folks, don't worry. We're not done yet. We'll be back in a little bit with our old friend, Mr. Greasy Meatball from Option Pit, to answer all of your questions. Another fun pro Q&A session. I'm going to go out on a limb and say there's going to be a lot of vol questions on that one and VIX. But we shall see. That's coming up next. Of course, if you want to check that out for yourselves, listeners, theoptionsinsider.com/pro, the place to go. Then back throughout the rest of the week and indeed the rest of the month with our usual assortment of content until we're back again, maybe talking about wheels on the next episode of The Advisor's Option. Stay safe out there, everybody.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.